So there's a rule in regards to becoming a real estate professional, which all of you guys can qualify as one. Okay, it stands like this, rep. A real estate professional is someone who either spends 750 hours in the year managing their rental portfolio, okay? Or they spend half of their time and more than any other person managing their real estate. So for this taxpayer who had gotten to a place where he's not hands-on in his business, he has now managed a few of his investment properties. By managing a few of his investment properties, he can leverage the cost segregation study to create a loss on his tax returns to make him essentially tax-free. But a lot of us taxpayers have a hard time spending 750 hours in the year managing real estate, because this comes out to about 13, 14 hours a week. Maybe it's hard right now for us to buy a rental property and want to even dedicate 13 to 14 hours a week to be able to use depreciation to offset our taxes. There is a loophole that the government created called the STR loophole. The STR loophole.
You call it a loophole?
Yeah. Is the short-term rental loophole. There are legal loopholes, if you didn't know, guys, by the IRS. Yeah, there are legal loopholes by the IRS. The short-term rental loophole means that you're running a short-term rental with an average customer use days of 7 days or less. So this property right here, we're occupying it for how many days? 4 days, right? So if you're running a short-term rental business, the government states that you only have to spend 100 hours managing your short-term rentals in the year to be able to use your passive losses to offset your active forms of income. 100 hours in the year comes out to 90 minutes a week. This is far much more manageable, okay? So for business owners who are starting to push into the 300K net, 500K net, 1 million net, you're gonna be in a position where you're either putting money into retirement accounts, deferring money, spending money on more items inside of your business, which maybe you do need or you don't need, or you can build a real estate portfolio where you start cash flowing from short-term rentals, because we all know how much this property is cash flowing, and pay nothing in taxes on your earned income at the exact same time legally. Since learning about the short-term rental strategy, we have had more clients approach us with zero real estate, and we've literally told them, go buy real estate. And they're shopping real estate. And I don't know how many of your tax accountants would tell you to do that. But in my office, one of the things that we do is we position ourselves in your shoes. And most of you guys just don't want to pay taxes, and we understand that. It's hard writing those checks. But a lot of us really like cash flow. And real estate is something that we can all wrap our heads around. It's something we can touch. It's something that's long-term. It's something that can appreciate in value. And at the same time, if real estate can give me losses that I can use to offset my active forms of income as I continue to grow, then I can live a more tax-free life. Now, let's say you're at the end of the year and you don't have time to buy a rental property, like many of our tax planning clients who get to the end of the year who find us. They don't have time to buy a rental property. Karlton, I'm sitting inside of an s-corp. What can I do? I have 500K net. Oh my goodness, what can I do? Okay, got it. Who's managing this entity? What do you mean? Do you have your own management company that manages your company? Karlton, I manage my company. I'm with my bookkeeper. I'm talking, to all my people in my office. I do my financials. No. Do you have a separate company that receives income from this company that gets to record a deduction? When does S-corps file tax returns, guys? March 15th. We got that coming up, don't we? Which means all of us who have S corporations are going to have to pay taxes come March 15th if you didn't pay your payroll taxes and have it withheld, right? But what if at the end of the year, rather than paying taxes on $500,000, you move $300K into a management C corporation that has a fiscal year end of, let's create the fiscal year end in September. What does that mean? When you establish a C corporation, you can determine the fiscal year end of when your tax year ends for that business. When do we end our year? When the ball drops in New York, December 31st, correct? Then we all go and file tax returns April 15th or March 15th if we have S corporations. When you start a C corporation, you determine when the year ends for the C corporation. So if I have a C corporation that ends September 15th, 4 months and 15 days from the end of this calendar year, I have to file tax returns for that C corporation. So that's September, October, November, December. So not until January of 2023 would I even need to pay taxes on this $300K that's inside of the C corporation. Okay, cool. I'm paying taxes on $200K right now, which means I have more cash flow as a business owner, but then I'm deferring $300K. How do I get access to this money that's sitting inside of a C corporation? Because I heard if you take money out of a C corporation, there's double taxation. Your C corp can loan the money back to your S corporation and you can deduct the interest. Now we're playing some games, Karlton. Oh my goodness. Are you sure I can do this? Yes, absolutely you can. How many of you guys have management companies? Does anyone have a management company? Boom. Okay, some people already have them. Okay, there are people tapping into this game. Okay, how can I get this tax burden down? Your S corp can assign expenses to the C corporation. Now we're playing a game. Guys, a lot of this stuff right here looks really cool on paper. It looks even better when your own numbers are being calculated in front of you. And you're saying, oh shit, I'm not gonna pay that? And then, okay, so I'm gonna move the expenses back over as I incur them this year because my business is probably gonna make more money this year than it did last. Oh, I start to get it now. And then Karlton's telling me to go buy real estate. And since I'm not paying taxes on $500K and I'm only paying taxes on $200K, I can go buy a short-term rental property and create, look, I get where he's going with this. And all the while, we're waiting until the very end of the year to actually touch those other things that our CPAs tell us to touch. Put money into your 401k. Put money into your SEP. Put money into your defined benefit plan. That's when we'll do all that stuff at the end of the year. Any questions on a management company and deferring taxes with a management company, or any questions on real estate professionals?
So, simple question. How does the loan process work between companies? Is there any legal compliance that you go through? Like, how do you actually make the loan compliance rather than just like transferring money through the bank account?
So you need to do a book to tax adjustment with your bookkeeper. This is something that we would have to train your bookkeeper on doing. So the process happens inside of your books.
Okay.
Mm-hmm.
So it's not like
and you do charge an interest rate, and the interest rate is deductible.
Okay. It's all based in books.
Yeah.
There's no like documentation of like this is.
Oh no, you'll create loan docs, absolutely.
Okay.
And it'll be over the course of usually about 15 to 20 years.
Okay.
That you're paying back the loan. How about I reverse engineer this strategy, right? Some of my high net worth individuals in here, maybe you're already in a C corporation. Some of you guys will realize it does no longer make sense to be an S corp. It will eventually become a point where you're making too much money that the S corp is no longer the vehicle for you to be in. C corps have a 21% permanent tax rate. Your S corp can go up to 37%, plus your state taxes. If you're in California, that's another 13.5%. You pay 45% in taxes, right? The C corporation just pays 21%. So when I pass over about 400K net income, I should be in a C corporation. But let's say I'm higher than that. Let's say you have a really high grossing business, right? You're an 8-figure ad spend, okay? If you're making a lot of money, you're probably going to transition to the C Corp, so you're at a 21% tax rate, but you still want to be able to pay yourself. Maybe you have employees. Maybe you have to offer 401k plans to your employees because some of them can't be contractors anymore, right? So you have to start offering 401k plans and all these other things and start paying into workers' compensation. You can establish an S corporation management company on top of the C Corp and reverse engineer the strategy as well, when your income has approached the right level, right? Because if all of my income is being taxed at 21%, wouldn't I want to take a deduction here and then pay myself as a normal S corporation over here, maybe like $100,000 that I just need, right? Why would I want to get double taxed up here? And since you're operating as a management company, you're managing your company from the convenience of your home. So you take your home office deduction over here, right? You take a vehicle deduction over here, which means this company's clean, right? If I ever want to buy this company, I don't see all your little expenses in there. It's over here in your management company. All income comes in through the C corporation. That's my operational company. And then my S corporation is my management company that receives income from my C Corp at the end of the year. Let's say you're coming to me at the end of the year and you're saying, Karlton, I'm not paying taxes this year. Boom, let's move money over into a C corporation. I'll help you get that money out of the C corporation. You see what I'm saying? I'm giving you a year-end strategy, right? Okay, now that you have money over into the C corporation, we just bought ourselves 12 months to figure out how to reduce that tax liability in the C corporation. Whatever we can't reduce is subject to 21%.